Good evening, viewers. Imagine this. Just days ago, silver was soaring toward unprecedented heights, brushing against $121 per ounce, a pinnacle that had traders buzzing with optimism from corner offices to online forums. Then, in a blink, it all unraveled. A staggering 30% plunge in mere hours, the most severe drop in over 4 decades. Gold wasn't spared either, shedding 12%, while mining equities tumbled in tandem. The headline screamed about a new Federal Reserve Chair nomination, painting it as a simple reaction to policy shifts. But as someone who's pored over market data for years, anchoring independent analyses and warning about economic pitfalls, I can tell you that's merely the surface gloss. The real mechanics run far deeper, into a web of strategic maneuvers that protect the powerful while shaking out the rest. Tonight, we'll dissect this event step by step, revealing the forces at play, the lessons from history, and how you can safeguard your investments amid such chaos. Stick with me. By the end, you'll see why this isn't the end of silver's story, but a calculated interlude. Let's start by setting the stage with the facts. Silver's ascent wasn't random. It stemmed from a confluence of real-world demands outstripping supply. We're in the midst of a multi-year deficit, where global extraction and recycling fall short of consumption by millions of ounces annually. Think about the solar industry alone. Photovoltaic panels require silver paste for conductivity, and with governments worldwide pushing renewable targets, installations are skyrocketing. Add electric vehicles, where silver enhances battery efficiency and charging systems, and AI data centers, guzzling power and needing silver-laced components for heat dissipation and circuitry. These aren't fleeting trends. They're structural shifts in our economy. Data from the Silver Institute projects a 2026 deficit exceeding 200 million ounces, the widest gap on record. Yet, amid this backdrop, prices cratered. Why? Because the market isn't a level field. It's segmented into realms where rules bend for the initiated. Consider the dual nature of silver trading. On one side, there's the physical market, tangible bars, coins, and industrial ingots bought outright. Premiums here, especially in high-demand regions like Asia, have held firm or even climbed during the turmoil, signaling unwavering real economy needs. On the other, the paper market dominates volume. Futures contracts on exchanges like COMEX, where leverage reigns supreme. Here, you don't buy the metal, you wager on its price with a fraction of the capital. For instance, controlling a contract equivalent to a kilogram might require only a third of the spot value as margin. This amplification means gains multiply, but so do losses. And crucially, exchanges can alter those margin requirements at will, often during peak stress. That's precisely what unfolded last week. As silver peaked, whispers of institutional positioning grew louder. Major players, including prominent Wall Street banks, had amassed significant short positions, bets that prices would fall. Closing these involves buying back contracts, which should theoretically buoy prices through added demand. But timing is everything. Reports indicate these closures coincided with a perfect storm. Key exchanges experiencing outages, margin thresholds hiked abruptly, and trading thinned by weekend closures in Asia. Coincidence? Data suggests otherwise. Historical logs show similar technical glitches during volatile episodes, allowing large entities to unwind without sparking rallies. When margins spike, say from 10% to 20% overnight, traders face a stark choice: inject fresh capital or liquidate. Most, especially retail participants stretched thin, opt for the latter. This sparks a chain reaction. Sales depress prices, triggering more margin calls, amplifying the downturn. Economists term it a liquidation cascade, and it's a tool as old as modern finance. To grasp the scale, let's crunch some numbers. Pre-crash, open interest in silver futures hovered near record highs, with speculative longs dominating. Post-hike, forced sales liquidated positions equivalent to tens of millions of ounces in a day. The velocity? Unprecedented, eclipsing even the 1980 Hunt Brothers saga. Back then, COMEX margins quadrupled, crashing silver 80% and bankrupting speculators. Fast forward to 2011, 5 margin increases in weeks halved prices amid a debt ceiling crisis, or December 2025's holiday thin trading, where a similar playbook shaved 20% off peaks. Patterns emerge. Volatility spikes when leverage meets intervention. And who benefits? Institutions with deep pockets weather the storm, covering shorts at depressed levels, then reposition for the upswing. Retail? Often wiped out, selling at lows only to watch rebounds enrich the survivors. But here's where my concern as an economist kicks in. This system isn't just volatile, it's predatory. It preys on asymmetry. Big banks access real-time data, influence policy through lobbies, and even sit on exchange boards. You and I, we're reacting to delayed feeds bound by rules they shape. The Fed chair narrative? Convenient cover. Yes, a hawkish pick strengthened the dollar, pressuring commodities. Bond yields ticked up 0.5%, adding headwinds. But correlation isn't causation. The dollar's jump was the spark. The powder keg was preset with leverage and opacity. Media amplification ensures panic spreads, fulfilling the cycle. Yet, amid the wreckage, fundamentals persist. Industrial offtake hasn't budged. Solar alone consumed 150 million ounces last year, projected to rise 20% in 2026. Mining output? Stagnant at best, with environmental regs curbing new projects. Inventories in vaults like LBMA are at multi-decade lows, forcing premiums up 15% in Shanghai. So, what does this mean for your portfolio? If you're dabbling in futures, heed this warning. Leverage is a double-edged sword, sharper on the downside. Time erodes your position through carrying costs and volatility drag. One adverse move, and you're scrambling for margin, regardless of your thesis's merit. I've seen seasoned traders fold not from wrong calls, but exhausted capital. Instead, consider exchange-traded funds backed by physical silver. No daily settlements, no forced exits, just pure exposure to the asset. During dips, you can average down, turning volatility into an ally. Data backs this. Over the last decade, ETF holders outperformed leverage speculators by 25% annualized per Morningstar metrics. But sizing matters. Never allocate more than 5 to 10% of your net worth to precious metals. Diversification shields against black swans. And monitor macro cues. Rate cuts, if reinstated mid-year, could weaken the dollar and reignite inflows. Diving deeper, let's examine the role of algorithms in these events. High-frequency trading firms armed with AI dominate 70% of COMEX volume. They detect margin shifts milliseconds ahead, front-running liquidations for profits. A study from the University of Chicago quantifies this. During 2025's dip, algos amplified declines by 40%, scalping billions. Human traders? Left in the dust. This tech edge widens the gulf, turning markets into arenas where retail is fodder. Yet awareness empowers. Track open interest via CFTC reports. Spikes in commercial shorts often precede squeezes. Watch for unusual volume in off hours. It's a tell for institutional repositioning. And in Asia, where physical demand leads, monitor import data from India and China. Surges signal bottoming. History teaches resilience too. Post-1980, silver rebounded 300% within years as inflation bit. After 2011, it doubled by 2020 amid QE. Even 2025's holiday crash preceded a 50% rally. Why? Deficits compound. With EVs targeting 50% market share by 2030, silver needs could double. AI's exponential growth, data centers expanding 15% yearly, adds another layer. Geopolitics factors in. Supply chains from Peru and Mexico face disruptions, while sanctions on Russia tighten scrap flows. As a concerned voice in this space, I urge patience over panic. Selling now locks in losses. Holding through resets captures the upside when sentiment flips. Now synthesizing this, the crash cleansed excess leverage, resetting the board without altering scarcity. Prices may wobble near 80-90 short-term, per JP Morgan's $50 warning if rates stay elevated. But models from Trading Economics forecast $95 by year-end, driven by demand. For you, the takeaway is strategic. Build positions gradually, favor non-levered vehicles, and view dips as entries. Ignore the noise, fundamentals whisper the truth. In recap, we've unpacked the crash's anatomy, from engineered triggers to protective paths forward. Silver's journey is far from over. It's primed for revival. If this resonated, hit subscribe for more unfiltered analyses. Comment your silver strategy below. Let's discuss. And remember, in markets, knowledge is your strongest asset. Thank you for joining. Stay vigilant out there.